Most buyers here, property taxes are included in their mortgage payment. So, when a separate property tax bill arrives months after closing, the first thought is, wait a minute, I already paid taxes with my mortgage. Why is the county billing me directly? If you are buying in California, that bill may be a supplemental property tax bill. It comes from the county. It is separate from your regular property taxes. Here is what's happening. California property taxes are based on the county's assessed value. The sellers may have owned the home for years. Their assessed value may be quite lower than today's market value. That can happen because we have Proposition 13. And Proposition 13 limits annual assessed value increases annually. Then, when ownership changes, the county reviews the transfer. That transfer triggers a reassessment. The county compares the old assessed value to the new assessed value. That difference creates the supplemental value. Here is a simple example. The seller's assessed value was $500,000. You purchased a home for $850,000. That creates a gap of $350,000. The county now calculates that additional property tax on the difference. Then that bill is prorated based on your closing date. California property taxes runs from July 1st through June 13th. So your closing date matters. Same home, same purchase price, different closing dates, different tax results. Now, here's a part buyers may miss. Your regular tax bill and supplemental tax bill are not the same. Your regular annual taxes are usually included in your mortgage payment. And that's when you have an escrow account. That means part of each payment goes towards your property taxes and your property insurance. However, this supplemental bill is separate. It is usually mailed directly to you, the homeowner. It may not automatically go to your servicer. Your servicer is the company collecting your mortgage payment. So, if that bill arrives in the mail, read it carefully. Check the due date. Check the parcel number. Check the bill type. Then contact your servicer. Ask if they can pay that specific bill from your escrow account. Ask how they want to receive this bill. Then get confirmation before the due date. This matters because escrow accounts are estimates. They are built around an expected tax bill and insurance bills that were provided during the pre-approval process, right? If your servicer pays an unexpected supplemental tax bill, now your escrow balance may drop. That can create an escrow shortage. Your future mortgage payments may increase, not because your rate changed, not because your loan changed, but because the escrow account needs to be rebuilt. That is why this conversation belongs before closing. At closing, taxes are usually prorated between the buyer and the seller. However, those prorations often use the current tax bill. That bill still reflects the seller's assessment value, not your future reassessed value. So a closing credit for property taxes may not cover a later supplemental bill. That is why buyers get caught off guard. They thought the tax conversation ended at closing. But in California, the county may issue a separate bill later. The better question is, were you prepared for it? Now, you want to know three numbers before closing. You want to know the current assessed value, your purchase price, and the estimated tax difference. That estimate will not be perfect, but it gives you a planning number, especially for first-time home buyers, VA buyers, and people with limited reserves. Now, a VA buyer may close with no down payment. That is a powerful benefit, but no down payment is not the same as closing costs and no post-closing expenses. You still need reserves. You still need awareness, and you still need to watch county notices after closing. This is not about fear. It's about preparation. This issue can also affect inherited homes. Families often focus on the title. Who can sign? Who can sell? Who gets the house? Those questions matter, but title and tax are separate issues. A trust may help with legal authority, but it does not automatically protect the old tax basis. That is where Proposition 19 matters. California changed the family transfer rules. A parent's low tax basis does not automatically carry over in every situation. The property use matters. The filing matters. The homeowner's exemption matters. The value and the timeline. So inherited properties need tax clarity early, not guesses, not old rules. Now, current county guidance, buyers need to ask this question. Could I receive a supplemental tax bill after closing? Especially for inherited property, here goes a different question. Will this transfer trigger a reassessment? Those are different questions. One important note, this video is focused on California buyers. Other states may reassess property after a sale. They use different names, different timelines, and different billing rules. So always check the county and the state where you are buying. Here is how I prepare my clients. During the payment conversation, I explain the possibility of a separate bill. Now, once the offer is accepted, we compare the purchase price and current assessed value. Before closing, I remind them to watch their mail for county tax notices. After closing, if a bill arrives, they review it quickly and contact the servicer before the due date. That is a calm process. No panic, no confusion, no guessing. Just clear steps. Here is the bottom line. Your mortgage payment may include regular property taxes, but a supplemental tax bill can still arrive separately. That bill may be valid. It may have deadlines and affect your future monthly payments. The goal is not to discourage. We're not here to discourage any buyers. The goal is to prepare buyers. When you understand the tax gap, you protect your budget. You avoid payment surprises. And you know exactly what to do when the county notice arrives. When it comes to property taxes, guessing fails. Get the assessed value. Get the purchase price. Get the county estimate. Get real data, not hype. That is how you protect the payment, the house, and the family.